All right. So basically for today, my goal is to really do a overview of how options work, how they're priced, how traders use them, why they're using them. And I'm not going to go over any advanced option strategies today, meaning I'm not going to talk about like selling puts or selling calls and selling puts or iron condors or anything like that. This is really going to be pretty much options basics, how to trade options directionally. So if you see like say for example on Microsoft, that was a play I posted today that some gains from that. I played July expiration on that. So it's 30%, 35% gain, which is great still. But I have time on it. And it really is a skill on knowing how to select the right strike price because you could, like I said to you before, Nick, you could have the right direction for a move, but you could still not make money or you could lose money if you pick the wrong strike price, the wrong expiration, or whatever. Like it's knowing how to play an option is a huge deal and really going to depend on how much money you make or how much money you lose. So that's really the goal for today. Like I said, I'm going to keep this to directional trading, meaning if you're long, you're going to play calls. If you're short, you're going to play puts. Nothing advanced because I don't even do that myself. And I want to keep it pretty straightforward because that's all you really need. And it's a great way to grow a smaller account or a great way to build wealth if you have a bigger account already. So let me just get into this for you guys. So agenda for today, what options are, contracts, strikes, expiration, what premium is, why people trade them, poor pricing, the Greeks, options chains, and some basic rules for us. Okay. And if you guys like, I know we have a smaller crew right now. If you guys have any questions, just stop me at any time. Um, feel free. You don't have to raise your hand or something. Just literally just speak. I don't mind. Okay.
10-4.
So a question, does anyone actually know what an option is?
I'm gonna say kinda.
Yeah,
Okay.
kind of.
Gives you the
Okay.
option to buy the stock at the current price in the future if it goes up, or reverse if it goes down. I believe that's how it works.
Yeah, essentially, yeah. So I'll give it this way, an analogy that I wrote out that would help. So I would say an option is best explained as a reservation with an expiration date, right? So the buyer, if you're buying a call, you're paying a fee now for a right that may become valuable later on, but you're not forced to use it. Meaning that if you buy an option and so a lot of people use options as a way of acquiring shares, right? Or you could use options against shares you already own. You could use options to collect premium. But for the sake of today, we're going to talk about trading options directionally. And in this example, I'm using this analogy. It's a reservation with an expiration date, the expiration date being the actual expiration date of the contract itself. And the fee you're paying for that is the right that it could become valuable later, but you're not forced to use it, meaning you're not forced to exercise it. Like Microsoft, for example, I sold some of those options contracts today. I'm not forced to use it or exercise it. So it's the reservation is there. If I wanted to potentially exercise it to buy Microsoft shares, I could. I'm not choosing to do that because I don't trade options that way. I'm trading it to make 35% on that play. Right. So, and you have two different types of options. And the call, like we said, a call is a right to buy the underlying option, and a put is the right to sell. So a call is a bullish strategy, a put is a bearish strategy. And honestly, if you do short markets, if you ever shorted stock, I know Brett has. I never shorted stock directly. I think options are a way easier way to short a stock versus shorting directly because with a put, your risk is defined. If you know about shorting directly, if you're shorting an asset, you can't short something you don't own. If you're shorting a stock, you're selling shares that you don't own technically. So technically, you're borrowing the shares against an asset you don't own, which requires margin. So it means your loss could be uncapped on it, right? But with puts, you can only lose as much as you put into the play. So I think it's indefinitely easier way to have a bearish outlook on something. So that's basically what an option is. So think of it as a contract that's tied to a stock or ETF. It has a few components to it. So when you're picking an option, it has a strike price. So what your strike is when you look at the options chain and Thinkorswim or Robinhood, you'll see, say, let's go for Tesla. You'll see you'll see dates, you'll see prices, you'll see Tesla 450 call, 450 put, you'll see 425 call, 425 put. That number, the 450, is what someone says strike. So if I'm asking you, hey, Nick, what strike price are you looking to get? When I say strike price, that's what I mean. I'm referencing that. So say, hey, I'm going to get Tesla 450 calls. And then other aspect would be like, okay, what expiration are you looking at? Oh, I'm looking at this week's expiration tomorrow because I'm a gambler. Hopefully that's not the answer. But if you want to be a gambler like that, you could do that. So does that make sense to you guys? A basic understanding of what an option is from a very high level standpoint. I would think of it, like I said, as you're having a dinner reservation or a reservation for something without forcing you to actually attend that reservation. So you're paying for the reservation fee, you're paying a premium for it. And if the reservation is not, say you don't go, it's unused, you don't have to capitalize on owning that actual asset itself. Right. And then I guess a way to look at puts is it's a bearish strategy of trading. If you're buying puts itself, say you want to short Tesla or a SPY or something like that, think of it as you're buying insurance, right? And the policy becomes more valuable when the damage risk rises. So as puts, they can gain value when the value of the stock falls. Does that make sense to y'all?
Yes.
All right, awesome. So this is some basic terminology you want to know for how options work. So underlying, I think y'all would know what underlying means. It's pretty straightforward. So underlying is just the underlying stock or ETF associated with the option itself. So every options contract gets its value from an underlying instrument. So Tesla gets its value from Tesla stock, obviously itself. It's different than trading the actual shares itself, but it's still getting its underlying value from the share or the ticker itself. Okay. The strike price, like we said before, that's the contract's reference price. So I'm gonna use Tesla again. Say you're playing Tesla 450 call. The 450 is your strike price, right? And the reason you have a strike price is if you want to exercise the option at any point, it's the price which you have the right to buy shares with a call or sell shares with a put at. So if you are intending to buy stock or own stock off of the contract you're in, the 450 strike is where you're gonna have that right to buy it at. Okay. So your expiration date is the date, the last date the option exists. So options cease to exist. It's not like shares where if you buy shares and you hold them, you have them forever. Options cease to exist at a certain point. Options that were for last year don't exist this year. They're forward looking, right? That's the point of options. So the expiration is the last date the option exists. After the expiration, it doesn't exist anymore. And that's why expiration is so important. The closer you are to contract expiration, the cheaper the option is, or the more volatile it can move, because that's just how premium works. We'll get into the Greeks for understanding how that works. These are components of options, but expiration is very important too, because like we said, if you're playing a zero DTE, which is 0 day to expiration contract, your moves gonna be very volatile in either direction. So you could, if you're very clean and crisp with your trades, you could capitalize on it quick, but you also lose a lot of money very fast. Okay. Your premium is the premium of the options market price. So that's the amount paid by the buyer and received by the seller when the contract's open. So when you see the contract listed, say you see 3.0 or something like that. So just know that when you see options, they're listed by dollar amounts. So you'll see like 3.00. It's not really $3. 0.3 will be $3. That's $300 for a contract. Or if you see an option that says 20, say like, what's a good example of an expensive option right now? Let's say Microsoft today. If you look at, I was playing the July 17th, sorry, 420 strike. That says 23.35. So those are $2,300 each, not $23 each. So that's the premium, how it's priced. Okay. And the other terms you want to know is I'll use abbreviations to this. I'll say ITM, which means in the money, ATM means at the money, OTM means out of the money. Okay. So a call is in the money when the stock price is above the strike, meaning that say Tesla's at 450 and your strike price you're playing is 440, that's an in the money call. You're in literally in the money. And that's closer to intrinsic value, which we'll get into as well. At the money means you're literally at the current price. So say Tesla's at 450, you're playing 450 calls, you're at the money. And out of the money means literally out of the money. So if you're playing, say you're anticipating Tesla go once you want to see Tesla go to $500, or you just want to see Tesla make a big move in the next few months, you could play a $500 call, which is very far out the money. But pretty much what you're doing is it has no, you see this line right here, it has no intrinsic value right now. The value is mostly time and volatility. You're pretty much paying, well, you're gambling in a sense that you're betting that Tesla will go a lot higher. It doesn't have to get to $500 for you to make money. It go to 475 or anything like that. But you're betting on the fact that Tesla has a lot of room to move in the future, so you're trying to collect on the upside to that move. Okay. Does that make sense as far as these terms? I think the ones you guys want to focus on here is knowing what a strike price is. Expiration is self-explanatory. In the money, at the money, out of the money are crucial to know. Does that make sense to you guys? What those terms mean?
Yes.
Okay, cool. KP, I know you just joined. We're just talking about different. You didn't miss too much.
Okay. Yes.
Okay.
Yep.
So let's see. All right. Let me go to my next slide here. All right. So here's the thing. People trade options for not only one reason. People do not, oh, it says it here. Cool. Yeah, there's multiple reasons to trade options. So one of the guys in the chat, he'll trade iron condors. Some people will sell puts. And selling puts is different than buying puts, to be clear. Selling puts is a bullish strategy. Buying puts is a bearish strategy. So for the sake of our conversation, I'm talking about just straight up buying the options itself and selling them for income, not using them to pay for premium and things of that nature. This is just a directional strategy, like I said. So for this sake here, we could also talk about it in this instance for hedging. So when say for example, when Brett a few months back or a few weeks back, he was talking about hedging against any downside moves with buying oil. Another way you could hedge is you could say you could buy SPY puts, right? And the reason you do that, say you have a portfolio that's $50,000, right? You could put $2,000 in the SPY puts, and those could do 100% easily if on any big move down. You can make another 2 grand on that on your portfolio right there without having to exercise a lot of capital. So that's why people would use options as well that hedge against any downside moves in your portfolio without having any large exposure to any, say, bearish equity names, meaning like say you wanted to play like SQQ, which is a bearish version of the VIX, or the QQQ, or you wanted to play UVIX, which is a leverage version of the VIX. So it's you have to buy a lot of shares of that. But the benefit with options, if you're hedging, is you could just buy SPY puts or QQQ puts and spend a fraction of the price which you would for the shares themselves, and you could still have bearish exposure. And obviously, the other reason that we all like options is you can make a lot of money on options, like a lot. Like, and you could lose a lot of money too. But like 500% gainers, 600% gainers they're normal options. If you get the timing right and you know how to select the right strike price, especially in this kind of market, it's very normal. Like the moves you guys see with Billy's small caps, you can hit that in options every day. But again, it's about knowing which ones to play. So I think the thing with people like about options as well is so you see here with defined risk. Um, Even though you could lose a lot of money if you play options the wrong way, you can't lose more than you put into the play. So your maximum theoretical loss when you enter a play, say you put $5,000 in a Tesla, that's the most you're going to be able to lose, right? But your upside gains, depending on what strike you're playing, are exponential. It's no telling. It's you can make 1,000% on a play. If you can make 10,000%, it's really exponential, which is awesome. And the other reason we love options is that you have leverage versus just buying shares like Brett does. Say Brett will play TSLL, which is 2x. I think TSL is 2x leverage Tesla. With options, you get even more leverage than that. And you have a lot of directional exposure with paying a fraction of the price which you would for Tesla shares. Tesla shares are $450, around that 400 something dollars. If you have an account that's 10 grand, you can't really do much with Tesla shares. But with Tesla options, you could do a lot with 10 grand. You can do some serious damage. So that's one of the main things we like about options is that it's a great way to grow a small account. Like I said, if I've taken accounts from 5K to 40K, and then like I've done small account like that before. It's fun to do, and it kind of helps you practice your discipline level, you know. So with a standard size, if you're just trading shares, you really can't do that. I mean, I'm sure some of you guys see trading shares. It's maybe a little more slow pace to grow your account, but things have changed now. We have a lot of leverage ETFs to play. So you could play TSLL, you could play PLT, you could play Palantir, even for ONDS, you have ONDL. So there's a lot of leverage shares that you could play, but it's still with options, just with a fraction of the price, you could trade a lot more leverage and get a lot more value out of that. This slide makes sense as far as why people use options. Or anyone have any questions on this?
Nope.
Okay.
I have a question about the those leveraged ones. So like CONL, where is that? What actually is it? Who owns it?
Yeah.
I don't
So
really understand.
no, that's a good question. So if you ever look at like Tesla and TSLL, those two charts, you won't see a direct one-for-one match in the chart, right? And the reason for that is I don't know if you're familiar with the concept in options that I'm going to get to. It's called theta, which is time decay. So I made a joke. I was talking to Brett, just busting a shop, not even busting a shop, just talking about someone we know who was like super confused about why the charts were different. I'm like, dude, you realize like these funds aren't just giving you 2x of what Tesla's worth because they like you. Like they have to invest it in something for it to be worth that, right? So those funds invest in different things every day, meaning they different derivatives and equity and things like that. So kind of like almost like trading options where the funds have to resettle every day. So there's decay in the fund. So you will see a difference in prices from the two charts. So when Tesla goes back to all-time high, TSLL won't be a one-for-one match at its all-time high. So those funds, so Direction is one, DIREXEON, it's spelled. There's a few other funds. So basically, you know how QQQ is under Invesco, you have these different people there's like Granite, there's these different hedge fund companies that offer leverage funds. They invest their money in different vehicles that give you the opportunity to leverage it. Does that make sense? You're on mute, Nick. I can't know if you have a question, but
Yeah, I think so.
okay. Yeah. So I was thinking about it this way. They're not just saying, hey, Nick, you're a cool dude. We're going to give you want to buy a Tesla, we'll give you 2x what Tesla makes. But if you lose it, you lose 2x. No, they're investing that money still.
Okay.
So do you guys remember when silver earlier this year had the historic short? So silver has ZSL, which is short, and AGQ, which is long. AGQ invest in silver as part of their leverage, right, for longs. So part of the reason why silver capitulated as much as it did is because they invest in silver. So when the price of silver, AGQ is just a leverage fund. It's not the underlying asset. The underlying asset is silver. But being they invest in silver, when the price of silver was plummeting, they had to physically sell their own silver to account for the loss they were taking. And that further drew down the price of silver itself because they're literally investing in silver as a leverage fund. So that's why silver capitulated as hard as it did. I mean, it was already had a massive short anyway, but it was like damn near a circuit breaker moment it was having. Like it was bad. So it capitulated even harder because they had to sell those assets. So that's one example. AGQ is for silver, but for other assets, they invest in other things. And Nick, I could send you some stuff on what those funds invest in, but that's generally how they derive their value. Did anyone else have any other questions? We're gonna go to slide 6. So there's two. This is really important. I know it's only a few words here. I'll talk more about it than so we'll have some kind of idea of what's going on here. So how options get their value is extremely important because how they get their value is also how they lose their value. So option premium is usually broken into intrinsic and extrinsic value. So intrinsic, it's pretty much the immediate value of the option itself, right? And extrinsic is pretty much what the market is willing to pay at a future date for it. Just want to pause for a second. Does that make sense? Intrinsic is pretty much what it's worth right now. Extrinsic, it's going to be what it could be worth in the future. So when you're buying that $500 Tesla call, you're playing on extrinsic value, which means that value doesn't currently exist, which is why those options are cheaper and you could lose more money playing those. But intrinsic value, that value currently does exist. So if you're playing closer to intrinsic value, you're playing closer to what it's worth now. So you're playing deeper in the money, and that generally will be more expensive to play. So if you guys see options contracts that are further in the money, I'm going to use Tesla again. So say if you're paying a 450 call that's closer to money, or say a 430 call which is in the money, it'll be significantly more expensive than a $500 call. Because the $500 call hasn't derived its value yet, but it's extrinsic. That value does not yet exist. The intrinsic call, that value already exists because it's close to, it's in the money. It's that value exists in the contract. It's a 430 call, 440, whatever it is. Does that make sense to you guys? It's crucial to understand intrinsic versus extrinsic value. And you're not going to look at an option and be like, oh, was this near intrinsic or extrinsic? No, it's going to be kind of intuitive. You at a point like, okay, I'm going to play closer in the money because I want to protect the value of this option. I don't want to play extrinsic only because you could lose a lot more money a bit quicker. Does that make sense to y'all?
Yeah.
I
Okay.
believe it does.
Sorry, you said, yeah, you guys said yes? I couldn't hear.
Yes.
Okay, cool. All right, gotcha. So, and part of the extrinsic value that's the most, I guess, one of the most crucial components is the time value. So time value meaning the expiration date itself. So time value is the most, I would say, like intuitive component of the extrinsic value for beginners. Because like more time means you have more opportunity for a favorable move. So the market would pay more for a longer dated option. Less time, a cheaper option, right? So as your expiration approaches, the time related value of the option itself is going to erode. So we're going to talk about Greeks in a second, but that's why like the extrinsic value part of that is the time factor as well. So if you're playing a Tesla $500 call, but you're not playing it 1 month out, you're paying it 1 year out, that has more value in the contract because you have the time value on your side. So the market is willing to pay more for longer data options because, simply put, you have more time for that move to happen, right? Cool. Do I have any analogies on this? Yeah, I do. Think of intrinsic value as what is already in the box, meaning the box that's what's already in the stock, what's already calculated in. Extrinsic is what traders are potentially willing to pay that a chance for something else to happen before the box closes. The box closing being the contract expiring, right? So that's pretty much what you're kind of thinking of when you're playing extrinsic and intrinsic value. So the easy way to look at this, I would say, my rule of thumb generally is I don't care what's happening. I think the biggest thing for options, right? Like you see, for Microsoft, we talked about it yesterday. Microsoft moved in 1 day, which is beautiful. We added it yesterday, moved today. We love when that happens. If I played this week's calls, I could have made 100% probably on that, right? Or maybe 50 or 60%. But if it didn't go in the direction I wanted to right away, I could lose that same amount of money too. So the rule of thumb I usually go with is playing as close to intrinsic value as possible and buying time for yourself as well. So as you're getting comfortable with options, I always recommend playing at the money or in the money and buying yourself at least 3 to 4 weeks to expiration, because with a lot of plays that Brett and I look at, they resonate in a week or two. But some of these longer ones, say like if you were playing ONDS, that's a play you want to go intrinsic value. Like you want to play at the money and you want to buy time, because when prices whipsawing back and forth, you're going to lose the value of that contract. So I'm going to go into that next on what determines that those whipsaw actions that happen, right? Okay. So here is the Greeks, right? So the Greeks are pretty much whenever you go into your options trading, you'll see the Greeks. And Robinhood, I think it literally just has the Greeks underneath it. And Thinkorswim, it'll list out theta, rho, delta, all that good stuff. I'm gonna be honest with you guys. I don't look at the Greeks every single time I'm trading and be like, oh, I need to see what the Greeks are like on this. It's something that kind of becomes intuitive where you keep it in mind, knowing when you're picking a contract, these factors are playing into the pricing of the contract, right? So that's kind of a piggyback off of the intrinsic versus extrinsic value. So the Greeks simply are sensitivity measures that estimate how an option may respond when one of the major pricing inputs change. They're not guarantees, but they help guide us understand how the premium may react to price movement. Okay. So the first one's going to be delta. Delta estimates how much the option price may change for a $1 move in the underlying asset, right? So long calls, so that's generally what we're going to do is we're going to long calls. Those generally have a positive delta because it's a long call, right? It's going to benefit from an upside movement. While puts are going to have a negative delta because they benefit from a downside movement, okay? So I would think of this as simple as this. Delta is your directional exposure. If you buy a call, you want positive delta working for you. If you buy a put, you want negative delta working for you. That's it, right? And you'll see that in the options chain. I have a screenshot of it in here. I'll show you guys. So delta, I would think of as a speed, right? Okay. Gamma's then the gamma's not on this slide. Gamma's on my next one. The heck? Where's gamma at? He son of a gun. All right, I'll just talk about gamma then. It's not, I thought it was on this slide. My bad. Okay. I'll just talk about theta first, and then we'll go to gamma after. Theta, I think the most important ones are delta and theta. Theta and IV is important too. Theta is pretty much your time decay, right? Theta estimates the impact of 1 day passing on the options value. So for long options you're buying, theta is your time decay that works against your premium on your positions. So think of it as like an ice cube that's melting because every day that passes, you're melting. You have less time to work with. So that's why I always say you want to buy time. So think of it this way. The longer you're holding an option that, say you have an option that expires next week and Tesla runs to 450 today, but you don't sell it and Tesla dips to 440 tomorrow, you're not only losing money on the premium of the action, you're losing money on theta as well, on time decay. So that's why it's always super important to buy yourself time on these. Okay. And Vega is pretty much it's like your uncertainty price. So when the market's expecting a bigger move, the long options become more expensive, even if it hasn't moved that much yet. So think of that as like, when you go into earnings and say you want to be a degenerate and you're going to play NVIDIA earnings, you want to long it, and you're going to see how expensive those contracts are, you're paying a premium on that for earnings because this is factored into the Greeks as well. Vega is how much it may change if the implied volatility moves by 1%. So you could make a lot of money on it as well, but you're going to pay a premium for that because there's there uncertainty behind it where the market's expecting a bigger move on that name, but it hasn't happened yet. So that goes into how the options are priced, right? It's almost like a marketplace. Like when a big event's going on, or say like a new concert's in town, say, I don't know, Drake's concert's coming out in Miami and everyone wants to go to the Drake concert. When you get closer to date, it's going to cost more. A big event's coming. NVIDIA earnings, everyone loves to watch NVIDIA earnings. So those contracts are heavily priced. And it may not even move at all, but you're still going to pay a premium just to play. Does that make sense?
Yep.
Cool. All right. So yeah, again, I wouldn't get overly concerned with the Greeks. The main thing I would say to know is pay attention to delta, right? But even more so is theta, and just not even knowing to look at it and read it when I pick options, I'm not reading this stuff. I'm just being honest with y'all. But I know how they work and I know what factors go into me picking the option prices I pick. So for example, Microsoft, I played, what'd I say? I played 420 calls, July 17th expiration. That's a month and a half out. and that's in the money. I could have played shorter expiration. I could have played further out of the money, made more money, but at the time I played, it was pretty close to at the. It was a little bit out of the money, but if I played further out of the money, I could have made more money on it as well. But my main point is just when I'm playing these options, I have these things in mind. So, how to read the options chain. So I think we'll picture this here. Yeah. What's this thing here? Okay, let's do this first. So when you look at your options chain, you're going to have a few components that it's going to show you, right? It's going to show you the strike, like we said, what price to level the contract is centered around, your expiration, how much time you have to let your trade idea play out, your bid and your ask. So bid and ask is important on options too, because especially for you guys trading small caps, you'll see this. Whenever you have a wide bid and ask spread, you generally have less liquidity and you get shitty fills on those plays. I'm sure you guys have seen that with some of Billy's plays, maybe. I'm not calling Billy's plays out. I'm just saying because you see that more with small caps. It's less liquidity. You have a wider bid and ask spread versus playing Tesla. But on options, say you're buying options on, I don't know, like certain names like Coin or MSTR, they have terrible spreads. And if you get a bad fill, you'll enter the position down money already. So very much pay attention to bid and ask. Like if you guys look right now, let me see. Let's see what Tesla's bid and not Tesla. Let's look at Coin. Coin always has a terrible spread. Let's see, Coin. Yeah, like I'm looking at. If you look at Coin, June 26. If you guys want to look yourself, 185 call. The bid and ask spread is 1305 and 1165. So 1305 is $1,300. 1165 is $1,100. 1165, right? So that means it's pretty much a $200 difference on your fill. So you could get a bad fill and enter the trade down $200 before you even anything happens without even the stock moving. That's just getting on a bad fill. So that's why with like picking your options contracts, you want to make sure your bid and ask is tight. And also too, if you market order into a bad spread, a wide spread, you're going to get a horrible fill. So you probably want to limit order and if the spread is wider. Does that make sense to y'all?
Yeah, but if you could do me one favor, it helps me understand a lot. If you can give me an example.
Yeah, for sure.
I'm not taking this advice. I'm looking at Coin right now, just like you are.
Yeah. So look at go to Coin, the options chain. If you can see June 26.
Yeah, that's what I've got pulled up. It's got all those
Yep.
the strike prices there.
Okay. Do you see 185 call? 185
yes,
strike? Yeah.
185 call down there.
Yeah. So do you see the bid and ask? It's like one, there's not much volume on that contract, but do you see it says like 1305 and then 1165?
Yes, sir.
Yep. So say you enter that. That's your bid and ask spread there. So you have about $200 or $150 of wiggle room of where you possibly get filled at. So how you're going to get filled matters on how much open interest and volume's there. If there's low open interest, that means that a lot of people aren't interested in buying that contract. So you have a wider spread. So that means upon you buying that contract to play it, you could potentially lose $150 on slippage just because it has low liquidity. So if you go to buy one of those contracts tomorrow, potentially, I'm not saying to buy this. It's not a trade signal.
No, I'm not.
Yeah.
I'm trying to learn.
Yeah, no, exactly. So if you go to buy this tomorrow, let's say the market, let's say it's 9:30 right now, right? And I'm like, you know what? I wanted to get the Coin 185 calls for June 26, and I get into that, and I don't limit it in. I could potentially lose $150 because I'm going to market in at the $13 price, the 1300 price, right?
Right.
And I'm going to lose that slippage on the bid and ask. So, and that doesn't happen with all plays. It happens with certain plays. Coin was one I knew off the top of my head because it's happening before with them. When I first started doing them, what the hell? How to lose $200? I just entered the trade. It's because the bid and ask spread was wide. Like with Tesla, Google, Microsoft, that rarely happens. Rarely. But with certain names that don't have as much liquidity, especially on the options chain, you're going to want to pay attention to that bid and ask spread so you don't lose money just by entering the trade itself.
Okay, I understand that.
Yep. So you want to probably limit ordering as close as the bid as possible, the lower price. And you may not get a fill exactly, set it a few cents higher just to get a fill as close to that price as possible. so you don't lose $150 just by entering a trade.
Gotcha.
I got a question about so I'm just looking at SOUN because I was thinking about buying an option for that for $10 sometime in July. Give myself
Okay.
months. July 17th, for instance, is what I'm talking about.
Okay, let's look at it. July 17th.
So I'm looking at the $10 call.
Mhm.
It's looking at 79.5% chance of profit. The break even, though, my question is 1054. Even
Don't
though
even so no other broker has that but Robinhood.
okay.
Yeah, don't even pay attention to that. That means nothing because options, I'll say this. Options have so many things that go into the potential value of what it could be worth at expiration or before that. It's incredibly hard to predict that. They have options calculators you could use. But when people were like, oh, wait, how much did this option could be worth? I'm like, I have no clue. I just know I want to long it, so I'm going to play it, you know? So that's how I look at it. And so, Nick, if you do want to play that, I would say just be careful that honestly, if you're playing, what's sound at right now?
871.
I got
Okay.
870 on TOS.
Okay. So look at the daily chart here. Yeah, sound didn't break out yet. So a $10 call wouldn't be bad to play, but while you're getting used to learning how to play it, give yourself another few weeks of expiration. And don't only be attracted to an option because it's cheap. And I'm not saying just you, Nick. I'm saying this as a reflection of myself when I first started trading options. Like, oh wait, this is only 50 cents. Oh, it's only $50. There's a reason it's only $50, you know? So you'll get burned quick on those.
Okay.
So I think so if you're looking at a $10 call, not that I think that's a bad call to play. July 17th is a good amount of time. And if you look, the other components we have on here too, what to look at. This is kind of like your options chain you're looking at. Your strike, we have the strike, your $10 your strike, right? We know our expiration, you said July 17th. Our bid and ask, we see it's a tight bid and ask spread. It's only 2 cents, which is fine. We could work with that. Volume, how active that contract is today, right? So our volume on that one is pretty good too. Volume on the $10 call was 8,872. That's pretty good. Open interest is pretty high on it, 17,288. So that's not a bad strike to pick. So the next component is you want to make sure your entry is clean though, because options are a lot less forgiving than shares are. You could still get you could get the direction right. You could have a terrible entry and you cannot make nearly as much money as you want to, right?
Right. So it just changed to, oh, now it's telling me the break even. Okay, got it.
Okay. Yeah. No other broker has break even but Robinhood. So, and I would love to tell you I know what they used to derive that. I don't know what they used to derive that. But the main thing is like you see the options chain there, and think about it this way: it's like seat pricing for an airline, right? Different seats cost different amounts of money based on the location and timing. Same thing with different options; they cost different amounts of money based on strike, your expiration, and your volume and your open interest. To kind of understand why two contracts, like think about it this way: you could be on the same plane, but if you're sitting in the front of the plane, your seat's a lot more expensive than it is in the back of the plane. Back of the plane is your 0 days to expiration or your same week expiration contract that's out of the money. That's the back of the plane, right? The front of the plane is you're in the money, you're playing far out expiration, you're close to intrinsic value, you're paying a premium for that. It's a good seat, right? You're on the same plane, but a better seat. So think about it that way. Any other questions? And if you guys want like to use examples of maybe options you guys, if there's any plays you guys had that we mentioned recently or that you're looking to get into yourself and you're thinking about taking an option on, throw it at me and we can use that as an example to help you understand it better or how I would pick the strike. So if you guys think of anything, just let me know.
No, I think I'm good.
Okay, cool. Let's go to the next slide here. And I'll share this deck out with you guys. So I would use this as like your basic checklist. And this is kind of like where my mind goes when I'm looking to trade an option, right? The first thing you want to do is when you're buying the option, are you buying it in the money, at the money, out of the money, and why are you buying it that way, right? because those choices you make are going to affect the delta you're paying on it, what the premium is, and that's kind of where your balance between intrinsic and extrinsic value comes in. So let's do it this way. The Y component, you guys may not know right now. I'll help you understand that part. So for me, Microsoft, I bought slightly out of the money because it's Microsoft, it's a high value stock, and for Microsoft to move $7 or $8 in one day takes nothing. So that's really, it was close to at the money. A situation where I'd want to play out of the money is, say, more so, I'm not recommending you guys do this right now. If I'm taking a short term day trade, right? So say like a good example would have been, I didn't trade it this morning, ONDS. Remember when I gave those levels for ONDS this morning? What did I say? 1150 or whatever to bounce at potentially. Let me see. What did I say? ONDS. Cool. I said 1125 to hold on any back test, defend the gap up, which it did. Trade worked out great. And a scenario like that with a day trade, when you get more comfortable with it too, like me personally, I would probably trade next week expiration, and I would have traded at maybe slightly out of the money. So like a $13 call when it was testing that 1125 spot, right? Because I had $13 an upside target too. And the reason you do that is you can make significantly more money when you're paying shorter expiration and out of the money. Like that was easily a 200% play today if you traded that way, right? So I would say that's when you want to trade out of the money. It's when you're trying to capitalize on a bigger move, and you would do obviously a shorter date if you're looking to day trade it. If you're looking to swing trade, give yourself a little bit of time. So that's when you ask yourself, okay, am I at the money or in the money? When you're at the money or in the money is when you're pretty much, you're trading a name that may be sideways and needs some time to develop, and you know that about the stock, so you trade it at the money or in the money. Or my recommendation is you always trade in the money to start or at the money, especially when you're learning options. Always trade in the money or at the money, but you could still, like I showed you guys, I told you, on Microsoft, that was 2 months out and pretty much at the money at that point, and it was still 35% play. Like, how often do you make 35% in a day on stock? That's very hard to do. But what options, you could do that very often, and you're pretty much protecting yourself by giving yourself the 2 months to expiration, and you're playing at the money. So you're not really dealing with your theta, your time expiration, because you have 2 months, right? And I saw Microsoft moving in shorter than 2 month time frame, and I was close to the money, so I'm not dealing with any crazy whipsaw action, right? So another component for your checklist is going to say, let's see, what's this? Strike choice. Am I buying in? We did that. Direction. Oh, that's the pretty much basic one. Sorry, I missed that one. Direction. Am I bullish, bearish, or neutral on the underlying? So I'm going to say this. If we're neutral on a play, we're not going to buy options on it. We're just not going to trade it. I'm only playing if I'm bullish or bearish on it. That's at least me. Some people play iron condors and things like that, and that's how you collect money on premium. But we're not going to talk about that today. We're going to keep this directionally bullish or bearish. So if you're bullish, you're buying calls. You're bearish, you're buying puts. Risk, what is my max loss and where will I exit if wrong? We were kind of talking about this in chat before about protecting your gains, and also the same with letting your winners run. So this is crucial with options too, because with options, you have to have a better risk appetite. You could be down 30 or 40% in a play, and depending on the strike you pick, especially, your play cannot be invalidated. You could go from being down 40% on a play to up 150%. I've seen it happen with options plenty of times. So that's something to keep in mind. So with your risk, I still would not P&L trade with options, for the sake that, like I said, you could be down 40% on a play, which would hurt, obviously. But if you're playing your chart and your levels are respected, don't just exit the trade but you're down a large percentage, because you're kind of doing yourself a disservice. And the same way where let your winners run. Like, obviously, if you're up 300% in the option, you want to take profit. Or even if you're up 100%, take some kind of profit. But if your final target hasn't hit yet and you think it's a realistic target, leave a runner in there. Let it play out. Because you could be up 200% on a play and your chart still hasn't hit its target yet. So I'll keep an eye on that as well for options. And then thesis window is important too. That was kind of what I was talking about with the ONDS example. Knowing what your thesis window is super important, because You need to know if your option play is expected to move fast or if you need time. And that's going to change what expiration you pick. And then the volatility component, that's important too. So there's a factor in options called IV. So has anyone ever heard the term, oh, I got IV crushed or something like that? So people will say that if you play a stock on earnings. So a lot of times what big money does is they will IV crush people. You'll see like Nvidia last earnings, I don't think it did anything. It was flat. Went up and went down and then opened flat because that kills the value of your contract. You could have had a contract, and honestly, if it goes up, down, up again, and then it goes up after, and you had calls and you were long, you could still lose money or close out completely. That's IV crush. So you're paying a premium for the volatility. So if there's more volatility, you're paying more money for it. So way back when I first started trading, Tesla was a lot more expensive contracts. Sorry, Siri's talking to me. So they were a lot more expensive then. So it was a volatile stock. Tesla's still volatile, but not as volatile as it used to be, I feel like, So you pay a premium for that though. And then also too, like we said, liquidity, that's with the bid and ask. So is the spread tight enough that I'm not donating edge? You don't want to donate just on entering the trade. So does this make sense here? This is kind of the general thing I would go through. Know if you're bullish or bearish. If you're bullish, you're buying calls. Bearish, you're buying puts. Your strike, in the money, out of the money. Think about your thesis window. That's how you're going to pick your strike price. Your expiration date. So, like Nick, like you were saying, I think you said for sound, right? You were looking at July. So that's kind of, you have to have that thesis idea. Okay, how much time do I need for this play to develop as I want it to? So that's July would be a good, potentially good expiration you could use for that. And then, like we spoke about liquidity and stuff before too. Any questions or anything here?
Um,
Right. Let's go to the next one here. Okay, so we were looking at this before, kind of together. I think you guys have an idea of how this works. You have one side that has calls. You have your expiration here, your strike price here, ticker and expiration as part of this. So you have, I think this is Apple. Just can't see it here. Your bid and ask we talk about. So you see your bid and ask. You want to have a tight bid and ask spread. You don't want too wide of one. Sorry, right here. You don't want too wide. A wider bid and ask, you'll get a bad fill. We spoke about strike and how it was listed out. They're generally going to be placed in a ascending order. So from lower price to higher price. And it's always going to be split out with you have calls on the left-hand side and puts on the right-hand side. I think that's how Robinhood is too. Yeah. You have calls on the left and your puts on the right-hand side. So pay attention to that too, because when you first started trading options, you could make a lot of silly beginner errors, and obviously buying puts when you want to buy calls would be very, very disappointing. So pay attention to that also. And then in Thinkorswim, you can see the Greeks as well. Again, I wouldn't get over focus on learning what each one means. Just know when you're picking your contract, how these factor into that. So the biggest one, like I said, is going to be your time decay and your IV, which is part of Vega. So IV is your volatility. So anything that has more volatility is going to have more premium priced into it. When you're leading up to a major event like earnings, you're going to see bigger pricing for that. So say, for example, Nick, I would pick on you again because you said sound. Have an idea when their earnings are too, because if their earnings are the week you're picking a contract, say the earnings are that week, say they are the week of July 17th. I'm not saying they are, but say they are, the contracts that have a higher premium that week because it's earnings week, even if you're picking it now. So pay attention to that. You don't want to pay your earnings value on a contract. So that's that there. And then beginner mistakes to avoid. So I think the biggest thing I would say is one is pay attention to the price of the options, right? So when an option's very cheap, there's a reason they're cheap. It's generally because they have a little bit of time left to expiration. You have a lot of theta decay that can hit you, and you can get the direction right, like I said, but you could still lose money if it doesn't happen quick enough. So pay attention to that. Also, to pay attention to overpaying for IV. Don't say Nvidia has earnings and you want to play Nvidia so bad. Just don't play it. If it's gonna be jacked up on prices, you're not gonna make enough money. You know, potentially lose more money than you are on playing it itself. So stay away from those. The ones that have the IV pricing where premiums are juiced up, Nvidia, Tesla before earnings, or even say right now like S&D KMU or juiced. Those are very expensive plays to play right now. And don't force yourself to play it or just try to play a cheaper version of it because it's expensive. It's expensive for a reason. That name has a lot of premium, a lot of movements every day. People want to play that name. And if it's not in your cards right now to play it price wise, then just don't play it, you know? So that's important. And then I would say the other one that, like I mentioned before, I've gotten into trades before and instantly entered losing by just entering the trade, which is honestly pisses you off because nothing even happened yet. And just by you pressing a buy button, you're down on a trade. So don't ignore the spreads. So those would be the big three things I would say to pay attention to. I'll make it a fourth. If I had to give everyone a golden guide on how to pick their options right now, play in the money or at the money, right? And buy yourself at least a month of time for now while you're learning, and pay attention to the spread itself. Make sure the spread's tight on it. So those would say the main, a high level of what you could walk away with from this is to do that. And this one here, yeah, that's pretty much all I had for today. I don't want to give you guys too much to digest. I want to go over basics and kind of give you the framework of how you can pick plays out that we're working on. So say like, let's see some plays we have lined up right now. We had Microsoft was one I played yesterday. Let's say, what's another one we have right now? Let's say Google. Google's been working decently. Google I have at right now. Well, let's get a chart up. Hold on one second. I'm going to stop sharing this. I'm going to use Google as an example. Google actually looks really good right now again. So I actually do like Google a lot. So this would be a good example. So let me share my Google chart here. Can you guys see my chart?
Yep.
Yeah.
Cool. So for Google right now, we had this daily demand zone, which I've mentioned before, and it's been holding this around 380, and it bounced off of it today. It's been holding its zone really well. You actually have a nice bull flag shaping out on the daily here. So tomorrow, say you want to play Google, you want to play calls. Let's see first if we can retest this zone here. Maybe let me get rid of these moving averages. Maybe we retest this daily demand zone, right? So we come back, it's 385, and you want to play it safely. My recommendation would be get some 385 calls and buy a month out expiration or 3 weeks. So play it, let's see, today's May 28th, May 29th, by the 3rd week of June expiration, 385 call. And while you're learning, buy one contract to start or two, something cheap, something not too crazy where the pain of a loss is going to hurt a lot, but where you could just buy a small amount and learn. So that's an example of how I would buy into Google, right? Or say in a scenario I was looking to day trade it, I would take, I'm not recommending you guys do this while you're learning, but if we retested this daily demand zone tomorrow, say I wanted to long Google, I'd buy 390 calls for next week because I'm looking to capitalize on out of the money move because I want to capitalize on a quicker move and a shorter expiration. So that it increase the potential gains I can make on that play. Does that make sense?
Mhm.
Yeah. Yes, we use Google as an example because it's kind of following the play we had out for it. Does anyone have any questions about picking options contracts, on any plays in the past on how they could have capitalized off options instead of shares? Any potential options plays you guys are looking to line up, anything like that?
No, I think I'm good. I
Okay.
got to get my feet wet with it.
Yeah, and Mike, I think the
I mean,
best
I'm
way if you, Mhm.
looking at Google right now. Well, you said you would, if I'm not going to do this. I'm not taking advice from you that way. But I'm looking at, like I said, Google. You said next week you'd buy like 390.
If I was day trading it, yeah, and I was looking for a quick move, my rule of thumb while you're getting your feet wet is just keep it to a month out. Keep it a 1 month expiration and at the money. So just because it's safer and you could still make a 20% or 30% gain on it, Mike, you know? So that's kind of what we were talking about when we started, like about kind of a, sorry, go ahead.
Sticking with Google, like I'm just, I got to see that. I got to see it in front of me. So we'll go June 18th.
Mm-hmm.
Oh, hold on. Pull up June 18th.
Yeah, so we could do June 18th, 390 call. Like that's pretty much at the money.
Okay.
Yeah. So if it comes down to say our demand zone tomorrow, or right now it's at the money because Google closed at what, 389. So 390 would be considered at the money. So that's a good way to play it. Or say it retreats to 385, you could play the 385 or the 387.5 call. That's more at the money at that point.
Okay.
Why is it 100 times? Why does it cost 100 times what the price is? So like the price is 11.35, but the cost to purchase this option for one is $1,100.
Because you're buying 100 shares.
Yeah. So options are coming in with the intention that you could so remember the example I used about a reservation that you're not taking.
Mm-hmm.
So think about it that you're technically, say you're reserving those 100 shares potentially, but you're not forced to buy them. So you're paying a premium for the option to potentially own those 100 shares, but you can exercise those shares. You could exercise that contract without owning those shares. Does that make sense?
So where does that 100 shares come from?
That's just how options are priced.
That's standard. Okay,
yeah,
cool.
That's standard. Yeah. So it's kind of like, in theory, you're looking to buy 100 shares of that contract, that option per contract. Okay. If it's exercised at the time of expiration.
Perfect.
But yeah, Mike, for that Google example, does that make sense for you then?
Yeah, in the money, at the money is where, a month out is where you're better at. You're better to do that. You pay a little higher price instead of waiting on it to go up. Like paper trading, I bought like 450 options on Tesla.
Mm-hmm.
It's like a month out. It's not at 450. So if it never hits 450, I think I'm going to lose that money. Correct?
No, you can still make money. So for example, like Microsoft today, it doesn't have to hit that price for you to play it necessarily, right? It depends about how fast it moves in the time period where you own the option. Okay. So say you buy, what's Tesla right now? Let's see. Tesla.
Tesla.
Let's go Tesla. Let's see. Tesla's at 442 right now, right? Let's say next week I want to play Tesla 450 calls. What's for June 8th expiration?
June 8th. Okay.
Yeah. It could never hit that 450 mark. It could hit 445. Say we do that tomorrow. We day trade it tomorrow. Tesla runs to 447 instead of 450. You would still make a bunch of money.
Okay. Yeah, because the option price is going to go up because it's closer to what the strike price is. So the closer,
and we're closer to expiration too. So exactly. So you'll capitalize more because we're close to expiration too. So the thing is, when you're buying short dated options and you're already close to expiration, you don't already own the option itself, right? So any theta or time decay that happened to it before, you're not worried about it. You don't own it then. But from the day you own it and you capitalize on a quicker aspect, you're making money off those quick moves. Does that make sense? So like say if we buy Tesla tomorrow, that expires next Friday, and it moves 10 points tomorrow or 5 points, you can make good money even if it doesn't hit the strike price itself. But say the person who bought the next week Tesla call 2 weeks ago and has been just bag holding every day, they're losing the theta because they actually own that option. Right? They're losing that time decay factor. The melting ice cube is happening to them because they're holding the ice cube. They're holding the ice cube into the expiration, right? They're holding it. You don't have that ice cube yet, Mike. So say tomorrow you decide to pick that ice cube up, but you put it right back in the freezer after and sell it. That's it. You're not getting the time decay factor. Does that make more sense?
I believe so. Just kind of like buying stock.
Yeah, exactly. But
get out as it goes up.
exactly. But the time factor is important too. Whenever it expires, the closer you are to expiration, the cheaper it is with the theta. But if you don't own it yet, so the scenario we're gonna use Tesla again, say I'm gonna pick on Carl. Say Carl bought because Carl's been trading Tesla. Say last week Carl bought Tesla 450 calls, right? And he hasn't sold them. He's been holding them. That's the ice cube. He's holding an ice cube. Expiration's next week. It's melting. It's melting a lot more because we're getting closer to next week. But Mike, me and you we didn't buy Tesla last week. You're like, you know what? I see a move coming in the next few days. I'm gonna play a short data expiration. I'm gonna play it for next week expiration or 450 call. We didn't take that ice cube yet, so it's not melting on us. We're not close to the expiration date because we don't have it yet. We're not holding it the whole time, right? We're picking it up now tomorrow and we're day trading it. So a quick move can happen because you're capitalizing it on it being shorter to closer to expiration. That Carl, who's been holding the whole time, he won't get that, but he's had all those days of loss already.
Okay.
Does that make sense?
Yes, sir.
Okay, gotcha. I like the ice cube example. The melting ice cube sounds like it makes sense as you get closer to your expiration date. Yep. KP, anything from you?
I should have said it before. I don't want to change the topic. My only question was regarding those leverage shares because that's a newer one to me that I feel like I could capitalize on, when, like you said, for the price of Tesla versus the price of the leverage version, it just, you can make more on it. But I made the mistake of going to ChatGPT instead of one of you guys regarding how it works and how to trade it. And of the AI, of course, on the side of caution is like, this is not something that you should hold because it starts fresh each day. And in my head, I'm like, oh shit. So it rolls over and I like completely misjudged it. And I've just used it as a day trade idea. But I'm like, then I see you guys holding nail and all these other ones. And I'm like,
yeah,
you can hold it.
So the thing with them is you can hold it. So kind of what we were just talking about with Mike about the time decay portion. These leverage ETFs have theta baked into it as well. So that's why the chart will never be a 1-for-1 match. So if we look at Tesla and TSLL, so Tesla, let's see, it's 52-week high. Let's see, its all-time high is that its all-time high? 499? Yeah. That's its all-time high, right? Now let's do this. Let's get TSLL up here. TSLL. Daily. Like it looks similar, but when Tesla retests its all-time high, TSLL, look how much further TSLL is from its all-time high than Tesla is.
Yeah.
Like Tesla's at 442. Its all-time high is 500 or whatever, 499. TSLL is $23. So that's a pretty big move it has to make to get to that all-time high. But that's because the fund, so chat was right, but the funds rebalance every day on what they're vested in. So that's why you have a time decay portion that's factored into these leverage ETFs where you don't get the direct 1-for-1 price that you do with the underlying asset. Right?
Okay.
So they're not just gifting you a 2x because you're cool. They're investing the 2x, and let's look see what TSL invested in. Let's find out. I don't know what TSL is invested in exactly. What is TSLL invested into 2x leverage? Okay, so they have equity swaps, which pretty much the bulk of portfolio is invested in swap agreements tied to Tesla. These are customized contracts with major financial institutions like JPM or others that agree to pay the fund twice the daily return of Tesla stock, collateral and cash instruments. Okay, so this is the part of the 2x that I was talking about. The fund's using derivatives to gain 2x exposure. It must hold the rest of its assets in highly liquid cash like collateral such as US Treasury bills and overnight cash. This ensures it can cover daily trading obligations settlement requirements. So it has to have a settlement every day, right? So it resets on a daily basis. So chat or whatever AI I use is technically right because it's meant to be a short-term trading vehicle because you don't get the same compounding you do with, say, you kind of lose some of the compound effect of it, meaning that like the long-term performance of the ETF is going to deviate from the underlying stock, but obviously you're still going to get more with TSLL than you are with Tesla.
Right. So potentially short swings, whether I think Tesla's going to go on a rally for, 2, 3, 4 days. That's not reckless to.
No, not at all. Even 2, 3, 4 weeks, honestly, you're good.
Okay.
Like if you're holding it for like 3 or 4 months, maybe you might like see more difference in it. Right. But I think for the most part, and you'll see Brett do this too, Brett kind of capitalizes quick on moves in TSLL because it happens so quick. You're kind of almost same concept with options. When you have a big move to the upside, you kind of want to capitalize on that premium gain you just got, So,
100.
So yeah, okay. Did you sell TSLL already?
Yeah, I've only day traded it, but there's been in the past few weeks where I've wanted to pull the trigger and I'm like, I would have made some money and I didn't because I was just kind of, I guess it's better to not just throw money at things I don't understand. So
no, it's good to kind of get a feel for it first, for sure, and get an idea of how it works.
Yeah.
But no, I see your point for sure because I get what chat's saying, but at the same time, like it's still way safer than options.
Okay. All right, cool. I can live with that then.
Yeah, for sure. And honestly, I don't think options are still inherently that risky. It depends how you're playing it.
Okay. Yeah, I got to get my feet wet with this one.
Yeah, so if you guys want, if it'll help you, when I'm talking about certain plays, I'll narrow my watch list down for ones that I think are options worthy, and I'll tell you what strikes you should be looking at if it helps you guys. So I can do that too to help you get an idea.
Yeah, that'd be helpful.
Yeah, for sure. So next plays I come up with a fresh watch list for. I'll give you guys an idea of what strike price you could play and what expiration. And obviously pair that with the levels I tell you to add at because that's crucial too.
Sounds good.
Yep. Anyone else have any questions?
Oh, just something else to dip my toes into.
Yes, exactly. It's always something to learn, right?
Yes, sir.
Carl, I know you joined late. I recorded it though, so I'll share it so you could have access to this, Carl.
Thanks, brother.
No problem. How was the pizza? It looked good.
It was all right. It was good. Just trying to rush it. I was in class and then I jumped in.
No, you're good, man. We recorded it, so I'll post it in chat. And like always, if you have any questions, just shoot me a note. I can help y'all out. So.
Oh, thank you.
Thanks, man.
Cool. Anyone have anything else?
No, think I'm good.
All right. Awesome. Well, appreciate y'all as always. If you guys have questions about options in general in the chat, let me know. And even if it's something where, say it's a play Brett posted and you're like, hey, I'm looking at this strike. What do you think? I'll give you guys feedback. So I got you. All right.
Yeah, I think I might want to try options. There's less capital going into it and all this day trading.
Yeah. I mean, honestly, swing trading options is not that bad. Like, especially because the moves happen pretty quick. If you get your levels right, we're sharing good levels with you guys, you can make some great money on that, Mike. So definitely worth messing with.
Cool. Thanks, Jason. Appreciate it. Have a good night.
No problem, guys. Have a good one.
Yep.
Thanks, guys. Have a good night.
All right, later.
Have a good night, Jason.
Thanks. Good night.